Welcome back to another technical analysis trading video. My name is Sam Morton, and in this video I'm going to teach the basic principles of money management and minimizing risk. There are two steps to developing a strong money management foundation and minimizing risk, and that is position sizing and portfolio diversity. And in this video I'm going to give my personal opinion on these steps and money management. I believe one of the biggest misconceptions when it comes to risk and trading is people give leverage a bad name. And they say the higher the leverage, the higher the risk. High leverage is bad, it's deadly. But I totally disagree with this opinion. I actually believe that one of the biggest risks in trading is having bad position sizing. In my opinion, it doesn't matter how big our leverage is, 1 to 10, 1 to 50, 1 to 100. It's our position sizing that increases or decreases our risk. If I was to have a CFD or spread betting account with a leverage of 1 to 10 and open a second account with a leverage of 1 to 50, with my second account all I would need to do is reduce my position size to trade with similar risk to my first account of a leverage of 1 to 10. It doesn't matter how large our leverage is, it's our position size that is the main factor in how much we're risking per trade. Strong money management includes having a clear set of position size rules. Our position size rules will probably not be a list of rules to follow, but something as simple as risking a certain percentage per trade. And once again, my opinion and recommendation is that per trade we risk 0.5 to 2% per trade or per position. No matter how good of a trader we are and how good our trading system is or trading strategy, there will be times we will make losses and there will be times we make a string of losses. And we need to ensure our trading accounts can take those losses and still have sufficient funds to enable us to keep trading. Hence my recommendation of 0.5 to 2% per trade. Some people may not like my recommendation of 0.5 to 2% per position. They may think that lowering their risk will lower their potential profit because they're likely reducing their position size. And that is correct. But let's take an example. If we were to risk 1% of our account per trade, and we were trading positions with strong risk-reward ratio, and for this example, let's say a risk-reward ratio of 1 to 4, which is very realistic, you're risking 1% of your account for a potential growth of 4%. And growing your account by 4% in a trade, especially if we are day trading or swing trading, is a huge amount. The second step to minimizing risk in having strong money management principles is portfolio diversity. When I think of a portfolio, the quote that always comes to my mind is don't have all your eggs in one basket. The majority of CFD and spread betting providers now offer a wide range of financial instruments. On the same platform, I can trade Forex, shares, indices, commodities, and more. So there's no excuse to not diversify our trading portfolio. Now, some traders may be totally in love with Forex or with shares or commodities and not be interested in trading any other category of financial instrument, and that is fine. But what I would say is still have diversity in your portfolio. If you're going to only trade Forex and you're currently trading the pound against the dollar, don't have your second instrument as the euro against the dollar. Choose a second currency pair that has little correlation with other currency pairs that you're trading. So if you're trading the pound against the dollar, perhaps the second currency pair could be the euro, Japanese yen. The third, the Australian dollar against the New Zealand dollar. To me, it's common sense that diversifying a portfolio minimizes risk. And also, not having all your risk on one currency pair, one share, one commodity is also common sense. If we're spreading our risk over 2, 3, possibly more financial instruments, our exposure is spread, which minimizes our risk. I would also suggest choosing instruments that complement each other. Once you have a set of trading results, either from backtesting a mechanical system or from live trading, you'll have a set of results, and some weeks or months you will make good returns, other weeks and months you may make a slight loss. What I would suggest is having a clear set of results for a number of financial instruments, either traded live, demo or backtested, and then choose instruments that have complemented each other in the past. So if a particular month the pound against the dollar with our mechanical system or trading strategy made a loss of 100 pips, but the Australian dollar, Japanese yen with our trading strategy or mechanical system made a profit of 300 pips that month, they could possibly be two currency pairs that we would have in our portfolio. The reason being, from past results, when one financial instrument has not performed well and perhaps made a loss, we have another financial instrument that has performed well. Thank you for watching these videos. Please check out our website, financial-spread-betting.com. Please like, please subscribe and view more of our videos.